Welcome to what has historically been our year ahead presentation. Instead of hosting an hour plus chart event, we decided to create a more targeted presentation. In the future, when markets are volatile, tax laws change, or there's other events that simply excite us, we plan to create similar updates. Again, welcome to Market Insights 2024. I believe you know most of the team. Whitney, our new addition at the bottom right, was instrumental in putting this package together. So thank you, Whitney. So the 2023 year in review, I think everybody knows that last year was really driven by just a few stocks. They were termed the Magnificent Seven: Apple, Microsoft, Google, Amazon, Nvidia, Facebook, and Tesla. Those 7 stocks were up on average 112%, while the rest of the stocks were up about 15. The total market was up 26. The equal weight index was up 12. I'll talk about that later. But it's estimated that these 7 stocks by themselves made up 70% of the S&P 500 returns. The dividend payers, those with a yield greater than 2%, just rose 6% last year on average. So what's going to happen in 2024? We'll start with the economy. The Raymond James forecast is for a modest recession this year. And when they say modest, they're saying it's going to be the most modest recession we ever have. There's a lot of talk about whether we're going to have a soft landing or modest recession. There's a lot of debate going on about what's going to take place there. I don't know that it really matters when it comes to the stock market. I'll talk about that more. But the only thing that would matter, I guess, is if the recession's much more severe than expected. The reason we expect a recession is because the Fed has raised interest rates so much they've really been trying to slow down the economy. And we think that they have been successful in doing so. Between March of 22 and July of 23, the Fed raised short-term interest rates by 5 full percentage points. Companies that had been borrowing for 4 or 5% that had adjustable rate loans are now paying 9 and 10%. And when it comes to 9 and 10% rates, I think a lot of companies are going to second guess expanding. Instead, they're going to be using cash flow to pay down debt. That's why we think there will be a modest recession. If companies aren't expanding, trying to grow, they're just not doing that next project, you're more likely to see fewer jobs created. Why do we think it's going to be a modest recession? I'm going to skip the first one, come back to that, but job losses have been low. With a recession, you'll see some job losses, but there are still very few unemployed people out there. Part of that is because the government is spending so much money. Infrastructure Investment and Jobs Act is still in full force and creating manufacturing types of jobs. AI is helping with productivity, so we're seeing people become more productive with working fewer hours and more accomplished. Household net worth is at a record. The stock market hit new highs, so people who have money invested in stocks or real estate have more money than they had before. And in some cases, they're not spending as much either. So the gas pump there, gas is actually lower than it was a year or two ago. So back to the first one, the no major economic shocks. No one anticipates an economic shock, but right now there really are a few things on the horizon. Maybe some kind of war with Iran, but let's hope that doesn't happen. So whether there's a recession or not, if there is, we think it's going to be mild. If there's not, that's not going to change things a whole lot about the way we feel either, because the economy is not going to grow in robust fashion. The Fed has already said they're going to cut interest rates next year. They wouldn't say that when I say next year, this year, 2024, the Fed would not suggest cutting interest rates if they weren't concerned that the economy is going to be weak. So when we talk about bonds, the fixed income market, interest rates were extremely low. At the bottom in June of 2020 during COVID, you could buy a 10-year government bond with the anticipation of getting a 0.5% annual return. So here we are 4 years later, and if you had bought that bond, you would have received a 0.5% interest each of the last 4 years. You'd still own that bond and anticipate another 0.5% a year for the next 6. Well, interest rates on the 10-year bonds today are about 4%. So nobody wants a bond that's only paying 0.5. They want bonds that are paying 4. And therefore, these bonds are way down in price. So those who had invested in bonds and safe bonds a few years ago are still way underwater. But with these new rates going forward, we do think that you're going to be able to get some interest from bonds. And I'll talk a little bit more about that. Our favorite spot in the bond market, municipal bonds, which are tax-free. Municipal bonds are now paying as much as they were clear back in 2007, 2008 at the prior peak. So it's the most they've been paying in 20 years. So interest rates on these bonds are very attractive. So let me explain a little bit about yield to worst. If you purchase a bond for 105 that's going to mature in a year and it's paying 6% interest, you anticipate 1% interest because you paid 105, it's going to go down to 100, so you lose 5%, so you only get 1. Most bonds today are trading under their actual value. It might be priced at 99 cents or 98 cents on the dollar for 1 year and be paying 3% interest. So if it's at 98 cents on the dollar and it's paying 3%, and it's going to mature in a year, the 98 goes to 100, so you make 2% plus you get your interest. So yield to worst and yield to maturity today are almost one and the same. These yields are good. That's all I want to really focus on there. In fact, they're so good that when you look at the municipal bonds relative to corporate bonds, relative to really any other type of bonds except for high yield or junk bonds, these municipal bonds are paying more interest on an after-tax basis. Now, big deal, they're not paying a lot more interest, and if you're in a moderate tax bracket, they're almost paying no more interest. But here's the big deal. The municipal bonds are historically extremely safe. If you had purchased a AAA municipal bond, waited 5 years, waited 10 years even, here's over 10 years, you see almost no defaults in those AAA bonds versus corporates. Again, very few defaults on a AAA bond, but it's almost 3 times as much as you would have on a municipal bond. So municipal bonds are very safe. Furthermore, when municipalities default, a lot of them really don't default. They go through restructuring. So Puerto Rico is a great example. The Puerto Rico bond market, Puerto Rico had some issues and they went into default. So what happened was their bonds were restructured. And those who own the bonds may take longer to get their money back. They may get a lower interest rate than they anticipated, but the bonds are paying out. Moving on to U.S. stocks. So there's optimism for 2024. One reason alone is just because when incumbents are in charge, they don't want to see the stock market go down. So in each of the last 11 re-election years, stocks have risen. Last year, we talked about how the Magnificent Seven did so well. Very few stocks last year, in fact, the fewest going back prior to 1990, outperformed the market. So it was a very concentrated market. We anticipate that some of the smaller companies will catch up, and I'll go into more details with that in a minute. This shows how the S&P 500 and the equal weight index, meaning had you put the same amount of money in all 500 companies, did very well in January. Then in February, they both kind of went down together. And then from March on, the S&P 500 went up dramatically, while the equal weight index went up some. In fact, the equal weight index just got back a little bit above its February highs versus the S&P getting way above its February highs. That was driven by those few stocks. And those few stocks listed here, I think it's interesting to see how much weight they carry. While we're on the subject of those Magnificent Seven stocks, they did really well in earnings through the fourth quarter of 2023. But if you look at their anticipated growth the next year, it's not any greater than the mid cap, small cap, and the rest of the S&P 500 index. So smaller, medium-sized companies are anticipated to grow their earnings just as fast as those big corporations. And because they didn't do nearly as well last year, they probably have some upside. International stocks, we talked a little bit about how the large US corporations are worth more than entire international indices. The US market since 2013 has gone up more than 120% more than its closest competitor in France. So this is really an astronomical difference. What's it driven by? Is the US really that much better? I don't know that it is. If you look at what's happened with the price earnings multiples, US stocks are now 50% more expensive than the rest of the world. So to put that in perspective, if you purchased a corporation for $100 a share and it earned $5 a share, that would make it 20 times earnings. The price 100 divided by the earnings of 5 gives you a PE multiple of 20. That's pretty close to where the US is, or maybe it's a little higher. The rest of the world, if you were buying their shares for 100, they'd be earning 10. So if those companies earned no more money, you'd still be getting a 10% annual return. Now they're paying, it's more like 26 and 13 times earnings, but regardless, the world index is trading at a much cheaper price than the US index. What's going on with the actual corporations inside those foreign countries? Well, a lot of foreign companies are expected to grow faster than US companies. In fact, you can see out of the top 260 some companies that are expected to grow their earnings more than 25%, only 3 are in the Mag 7. So there are a lot of opportunities out there. So what happened with commodities last year? What do we anticipate in 2024 with commodities? Last year, the commodity index stayed below its 200 moving day average. According to Gunlock, he thinks that that's further corroboration of less than fully robust economic growth. Jeffrey Gunlock is considered to be the bond king. He's anticipating a recession just like our analyst. I think he's in the camp that it's going to be a little worse than what Raymond James anticipates. So in conclusion, stay diversified. This shows different asset classes: real estate, foreign stocks, US stocks, a blended portfolio, cash, bonds, commodities. Had you invested in all of them, which one did best each year? Real estate's up at the top here. You can see difficult for asset classes to be on the top 2 years in a row. In 2009 and 10, real estate was at the top, and in 2019 and 20, US stocks were on top. If you look at what happened last year, stocks were up 26% in the US, foreign were up 18, real estate was up 10, bonds were up 5, cash was up 5, commodities lost 12%. What's going to happen next year? Well, we don't know, but had you bought whatever did best the prior year, so if you said, okay, US stocks were best last year, so let's buy them again this year, had you done that, on average, your return would have been negative 5% per year. If instead you bought whatever did worst, so if we bought commodities, which did worse last year, on average, you make 1% a year. But if you have that blended portfolio and invest your money in a diversified approach, you've averaged 6% returns. We think this is a really good year to diversify. I think diversification is clearly the best option for 2024. Over the last few years, I've often discussed how bonds were providing return-free risk rather than risk-free returns. Now bonds are paying interest, so they are providing returns. And while they are not risk-free, they certainly are less risky than US stocks. Small US companies, international companies have not kept pace with the Magnificent Seven or other large US corporations, so they have some value. And finally, those big companies could continue to lead because AI is in its infancy. If you found this presentation valuable, we hope you'll thank Kendall and Whitney for putting it together. And if you didn't find it valuable, blame me. Regardless, we at Gerhardt & Associates look forward to seeing you this year, connecting with you personally to discuss the markets. And with that, I wish you a happy, healthy, and prosperous 2024.